Welcome back to the Multifamily Review. I'm your host, Marcus Armstrong. And if you are on site or in the C-suite right now in late 2025, you're probably feeling the pressure. You're in the trenches dealing with the tail end of a truly historic supply wave. Concessions are elevated, rent growth feels flat, and it seems like a renter's market. But what if I told you that this story is already over? That the market of 2026 and 2027 is set to be the complete opposite of what you're experiencing today. Today we are talking about the great supply hangover. We're going to connect the dots between the high interest rate environment of 2023 and 2024 and the supply drought that is set to begin in 2026. This is the story of a violent swing and how tomorrow's market was built 2 years ago. To understand where we're going, we have to be brutally honest about where we are. The 2024-2025 period was a record breaker. You have to go all the way back to 1974 to find a year where more apartments were delivered than in 2024. This year, 2025, is the final peak of that wave. Yardi Matrix projects that a staggering 547,779 total units will be completed by the time the ball drops on New Year's Eve. This is the hangover we're all feeling. It's the source of pressure, the concessions, and the fight for residents. This is what's suppressing rent growth in high supply markets. But here's the critical point. We're all busy leasing up these brand new buildings. The factory that builds these new apartments has quietly shut down. The pipeline of future projects has fallen off of a cliff. I want to read you a few data points that should stop every operator in their tracks. First, by the middle of this year, new multifamily construction starts were already 74% below their 2021 peak, according to CBRE. Second, data from apartments.com confirms this, showing a 71% drop in starts from the peak in the first quarter of 2022 to the third quarter of 2025. And finally, Cushman & Wakefield reports that the overall construction pipeline is down over 50% from its peak. Get this, it is now 17% below the pre-pandemic average from 2017 to 2019. This isn't a slowdown, it's a full stop, brakes on, crash. To put that in perspective, that 71% drop in starts means that we went from a peak of 210,000 units starting construction in a single quarter down to just over 60,000. Data from Cushman & Wakefield shows that starts activity has fallen to levels we haven't seen since 2012. This slowdown is widespread, and it's hitting the biggest markets hard. New York, for instance, led the retreat, shedding over 22,000 units from its pipeline. This was followed by Sunbelt giants like Dallas, Fort Worth, Austin, and Houston, which each saw their pipeline shrink by roughly 13,000 units. The factory is closed. So what caused this? Was this a lack of demand? No. This is the most important part of this story. This market dynamic was not driven by a lack of demand, it was driven by a crisis in financing. The NMHC quarterly survey confirms it. The top reasons for construction delays and canceled projects were economic feasibility and high interest rates. Similarly, Cushman & Wakefield identified expensive construction loans and a challenged fundraising environment as the primary culprits. In fact, NMHC's chief economist, Chris Bruin, summed it up perfectly. He said, and I quote, "The primary cause of decreasing starts and construction delays is one and the same. The combination of low rent growth, persistently high interest rates, and rising operating costs are making projects increasingly difficult to pencil." The math simply doesn't work. NMHC President Sharon Wilson-Gino confirmed this, stating that the economic uncertainty, high interest rates, rising insurance costs, and the increasing construction costs all continue to make the building of badly needed housing challenging or even impossible. You're hearing it from all sides. It's the cost of capital, the cost of insurance, and the cost of materials. And on top of all of that, developers are now telling publications that they are actively avoiding markets with new rent control laws because those regulations cap their exit valuations and make the deals impossible to underwrite from the start. Think about it. The 2026-2027 supply drought is a direct causal consequence of the capital market conditions of 2023 and 2024. The decisions made, or not made, in the high rate environment of the last 2 years are what will define the next two. So, We have a peak in completions hitting us now, but a crash in starts that already happened. This creates a predictable, data-backed supply drought just over the horizon. Let's look at the forecast. Yardi Matrix, which projected over 547,000 units completed this year, forecasts that the number will fall to 430,061 units in 2026. And in 2027, it plummets to just 360,000 units. That brings the market right back to, or even below, historic norms. The pendulum is swinging, and it's swinging fast. To put that in perspective, CBRE has stated that this decline in starts means that the new deliveries will be reduced to less than half their current level by 2026. Other analysts are forecasting that new multifamily starts will fall by a staggering 53.8% in 2026 alone. This is the definition of a supply drought. Yardi Matrix, the same group that gave us those 2026-2027 numbers, is already projecting what happens after the drought. They forecast completions will hold around 410,000 units in 2028, before construction starts to rebound, leading to completions climbing back upward towards 450,000 by 2030. This shows the entire cycle, a massive supply wave now, a deep supply drought from 2026 to 2028, and then a slow climb back to normal. We are heading directly into a 2 to 3 year window of dramatically limited new supply. This brings us to the punchline for every operator and investor listening. This shrinking pipeline is the primary reason that most analysts are forecasting a market recovery. CBRE is on record predicting that this shrinking construction pipeline, combined with the strong renter demand, will precipitate above average rent growth in 2026. CoStar concurs, projecting national rent growth to accelerate to 1.9% by the end of next year. Here's the key takeaway for your 2026 budgeting and strategy sessions. The operational pain you feel today is temporary. It is based on a supply wave that is, for all intents and purposes, already over. The strategic decisions you make in 2026 in your budgeting, your marketing, and your renewal strategies cannot be based on the market of today. They must be based on the coming reality of a shrinking pipeline. The market of 2026 and 2027 was forged by the capital markets of 2024. The drought is coming. The only question is, are you ready for it? Thanks for listening to the Multifamily Review. Make sure to like and subscribe.